So lecture 5 covers the first part of capital structure, and the midterm will end here. The first part of capital structure is chapters 15 and 16. What they're going to talk about in this lecture is basically the different types of external financing: debt, preferred shares, and common shares, and break-even EBIT, which is an estimate of at what level of profitability does it make sense for the company to be adding debt. And then the homemade leverage and the M&M cases are more financially theoretical. We'll get to those in a bit. Let's start off with the three types of external financing. So we have debt, we have pref shares, and we have common shares. Okay. And common shares are really equity, and debt is debt. Okay. Preferred shares are sort of a hybrid between the two. So if you look at a company, for external sources, those are the primary ones that they will deal with. And I'm going to go over them one at a time. So for debt, remember the previous lecture we said that the textbook really considers debts to be bonds. It can be a bank loan, but they deal with it in terms of money that's being issued or loaned to the company by the bondholders. And why would a company use bonds instead of a bank loan? Because it allows the company to set the terms. Okay, so set the terms of the debt. If you go to a bank, the bank is not going to allow you to set the terms. They'll probably tell you what the terms are and you take it or leave it. In the case of bonds, you set the terms as long as they're market value. Like you can't offer 2% return when everyone's offering 5%, but as long as there's, within reason of market value, you can play around with how long it takes you to repay it and other key terms like that. So the terms of a bond are called the indenture. Okay, and this is essentially a document, a large legal document that details the terms. Okay, so very few people will ever read an indenture, but you might have a one-page summary that's of use. The other term to be aware of is something called a debenture. This is an unsecured bond. Okay, so an unsecured bond means you have no collateral. So an example would be like if you buy a house and get a mortgage, you have collateral on that when you take the loan. The bank can take your home if you wish to get, or if you don't make the payments. So it is secured. Unsecured would be like your MasterCard. Your MasterCard can't take any of your assets. They can put your credit rating in a bad scenario, but they're lending it to you on your good credit rating. They're not tying it to an asset. The vast majority of real life bonds are actually debentures. They're called bonds, but that's just a colloquial term for them. The real technical legal structure is that they're debentures, because when Apple issues a bond, it's not tied to their real estate buildings or anything like that. Okay, the next type will be preferred shares. And these are a bit of a hybrid between debt and equity. They're probably closer to debt. Okay, but I'll write here, these are between debt and equity. And while they have no ownership, they have no control or ownership in the company. So they're different from equity from that point of view. And they're different from debt because they will pay a fixed dividend. Unlike bonds, so it is not interest. So instead of interest, they pay dividends, and those are taxed differently. So that's really the big difference. And why do people buy them? They're called preferreds because they are ahead of common shareholders in bankruptcy. Does that mean anything? Probably next to nothing. I'll get to that in a second. So that is preferred shares. Let's go to common shares. Most people know what those are. So those are the owners of the company. They share in the profits, which the other two do not. So debt is getting their interest paid out of the profits. Preferred shares is getting their dividends paid out of the profits. But the common shares get all the profits after all the payments are made. And a couple of terms the book talks about regarding common shares is IPO, is an initial public offering. And this is the first time shares are issued on a public exchange. Okay, so a public exchange would be like a stock market. So Toronto Stock Exchange, New York Stock Exchange, any exchange in the world. If it's listed, it is now a public company. Once it's a public company, if it does future issues, it's called an SEO. That's a seasoned equity offer. Okay, so this is when a public company that is already public issues more shares, which happens fairly often. So if Apple was to issue shares to raise some financing, that would be an SEO because it's already public. So if we do a little bit of a summary of the key items, so let's look at common shares versus preferred shares. So what's the main difference between these? Let's look at the categories and we can determine how they stack up. So in the case of control, common shares have the right to vote. So essentially, they control the company. They pick the board and they set it up. For the most part, preferred shares traditionally have no voting rights. Okay, so they're not running the company, they're just getting paid dividends that were fixed. Okay, so let's get to the dividends. Both will pay dividends. Common shares is optional. And with preferred shares, they are fixed and stated. So you're told in the shares that you will get X% dividend. Common shares, if you look at, Canadian banks, some of them have paid dividends for 100 years straight, every quarter. Does that mean they legally need to pay next quarter? No. They can say, no, we're done paying dividends. Their share prices will go down dramatically, so they're not going to do that. But there's no legal obligation to do it. There's another reason for that. We'll talk about it in another chapter. Bankruptcy. So this is a big one. Common shares holders are last in line to collect. Okay, so whatever's left over, the common shareholders will get, and the preferred shares are ahead of the common shares. Okay, so what does that mean? It may sound good. It probably in reality means nothing, because who's ahead of the preferred shares is debt. And in the case of bankruptcy, most debt holders get a very small portion of their money back. So if a debt is not being repaid, preferred shares have no hope of getting their money back. The last thing is the market price of shares. What causes that to move? Really, in the case of common shares, it's based on performance of the company. And by performance, I mean net income. Income goes up, share price goes up. income goes down, share price goes down. In the case of preferred shares, it is also based on performance. So not so much when it goes up, but if it goes down, share prices of preferred shares will fall because there's now risk that it might not be paid. But it is also based on interest rates. So just like bonds will fall when interest rates go up, preferred shares will also fall. So there's a lot more volatility in preferred shares than there is on bonds.